Okay, last time we finished with calculation of the weighted average number of shares outstanding. Why do we need those one? The number we needed to be able to calculate earnings per share. Now the earnings per share, as you remember from last time, let me lower this one a little bit. This earnings per share, as you remember from last time, is net income minus preferred dividend, the dividend that we pay for preferred shares divided by the weighted average number of common shares outstanding. That will be the key here, weighted average number common shares outstanding. Now the question usually gonna have how the shares are, what's the number of the shares for the period of time during the year. So what you have to do is to get the fraction of the period of time times the number of shares and to calculate over the years how many shares are actually outstanding on the weighted average basis, which will be one way to do is to get the portion of the months with the shares outstanding and get the total at the end, or number of the months times the number of shares outstanding. And once you get the calculation at the end divided by 12, there are different, I show you three or four different ways to calculate this with Excel spreadsheet. Use that Excel spreadsheet when it comes to the questions with the calculation with the average. Now, what's going to happen if the company decide to declare share dividend? Now, the share dividend for every, let's see, this case is 10%. So once the company declared the 10%, from that point going forward, the number of the shares will be whatever the number of shares is with the 10% increase. But the problem is that the previous number of shares up to the point of the declaration of the share dividend do not include the 10% stock dividend. So for that reason, we have to bring the stock dividend and recalculate like happened from the beginning of the year. That's one way to do it. The other way to do it is stay with the original number of shares without the 10% increase and do the calculation. And at the end of the calculation, add the 10%. That's another way you to get the same number for the weighted average number of shares. Again, last time I showed you that one. Exactly the same, which is with the stock split or with the share split. Once the share split happen, we automatically double in this case, 2-to-1, then we double the number of shares. At that point, until the end of the year, we're using the new number of the shares. But that stock split doesn't apply for the previous yet. So what we have to do, we have to go back and change the number of the shares to reflect the stock split or share split as it happened from the January 1st. That's one way to do it. The other way to do it is forget about the split, calculate all the way for the entire year with the normal number of shares, and then at the end, apply the stock split. Either way, you're going to get the same number. Now for the earnings per share, the other thing that we have to do is preferred dividend or the dividend owns to the preferred shares has to be deducted on the calculation. And we're going to have a basic earning per share, which is based on the net income and diluted earnings per share. Since all of you are going to continue with the accounting, diluted earnings per share you're going to see in intermediate accounting second part, which I believe is the number is 332, of course. If you catch me there, we're going to go to this calculation again. If you don't remember it, please remember it. That's going to save your life because the earnings per share is going to come again and diluted earnings per share is going to come again. Diluted earnings per share means that we have to assume that if there are any options, any conversions, anything like that, we pretend that already happened. What that means is that's going to increase the number of the common shares, weighted number of the common shares. And since the net income, there will be no changes, or most likely there will be no changes there, that will give us the diluted earnings per share lower number than the basic earnings per share. Basic earnings per share, again, is the net income divided by the weighted average common shares outstanding at the moment, where the diluted is we pretend that all the options and all the rights are converted into common shares. And obviously that we're going to decrease the number for the diluted earnings per share. Price earning ratio is the market value of the shares divided by the earnings per share. Now the price earning ratio we're going to give you is what's the relationship with the market price versus the earnings per share of the company. Statement of the retained earnings is the last thing for this chapter that we skipped last time, is the statement of the retained earnings. As you probably know from the accounting 201, starts with the retained earning at the beginning of the year. Then we're going to add net income, or we're going to deduct the subtracted net loss, if there's any loss on the current year. Of course, you cannot have a net income and net loss in the same year. That's impossible. Then we're going to deduct the dividend that the company might have declared cash dividend or stock dividend or share dividend. And then we're going to come up with the retained earnings. That's a statement of retained earnings. That will come up with the retained earnings at the end of the year. Once we do that, then then we can prepare statements of shareholders' equity. Now the statement of the shareholders' equity, again, is going to start with the balance of the total shareholders' equity at the beginning of the year, divided by different sections. One section will be, depends on the type of shares that the company has. If this company has, for example, preferred shares is going to come first. Then it's going to be common shares, then going to be contributed surplus from the repurchase. Retained earnings is the last, and total shareholders' equity. You may have other comprehensive income, but we're going to talk about this in the 332. So again, we're going to start with the balance at the beginning of the year or the end of the previous year. It doesn't really matter because the difference between ending balance and the beginning balance is 1 second. So for that reason, which balance you're going to show here, December 31st, 2022 or January 1st, 2023, the number will be exactly the same. Then, as you can see here, we issued new shares during the period of 1 year from December 31st, 2022 to December 31st, 2023. We issued 100,000 common shares and we purchased back 40,000 common shares. Because of that, now during the year, company generated net income and pay cash dividend. And when we repurchase the common shares, obviously here in this case, we repurchase the common shares below the average price of the shares based on our books. And that triggers the contribution surplus on the common shares. And then we have the balance of December 31st, which is simple calculation of the vertical for the all elements of the common share, contributed surplus, retained earnings, and total shareholders' equity, which the total shareholders' equity is horizontal calculation of everything that we have on every single line of the shareholders' equity. Now, the next part, on the next slide, what we're going to see is let me see if I'm missing something. This is the restriction to retained earnings. Some company can impose restriction on the retained earnings. Now we can have a legal restriction, or we can have a voluntary restriction. Legal restrictions, those are related to the third parties which have interest in the company assets. For example, if the bank give the company a loan, bank wants to get their money or the principal back. Now, in order to do that, every time when the company generates income, the bank will be happy because the company generates income, which has to be retained. Now, imagine if we owe the bank money to the bank, and every time when we have income, we are actually distributing that income as a dividend to the shareholders. Well, obviously, banks not going to be happy because again, banks want to get the money as soon as possible. So for that reason, the bank may impose restriction to the dividend or to the retained earnings and say all the retained earnings should be kept in the company until the loan is paid. The other thing, we can put some voluntary restriction on the retained earnings. Those were called appropriations. And appropriations, although the appropriate handled through the journal entry, are separate reported in the statement of the retained earnings. Now, the restrictions on dividends and shares repurchase may be required by the lending institution, which is the bank. So basically, bank doesn't want we to spend money for the dividend or repurchasing our shares back. They want their hard money. Accounting errors and changes in the accounting policy. This will be very, very briefly here. So you can have an idea that this one exists, but again, we're gonna talk more with you when we see each other intermediate financial reporting second part, accounting 332. Now, the errors and changes in accounting policy will trigger some changes on the financial statements and the retained earnings. Now, as you remember from the previous course, 201, the first thing that the company doing is the income statement. Now, once the company prepared the income statement, revenue minus expenses, the income statement ended up with the net income. Now, the net income moved to the retained earnings, which is part of the shareholders' equity. So that for that reason, shareholders' equity, statement of shareholders' equity is the second statement, which naturally the company prepares, which you have the balances of the beginning balance, and then what's happened during the period. The company generate income, which increasing the retained earnings. Did the company declare dividend, which will reduce the retained earnings, respective the shareholders' equity. Then we finish with the ending balance shareholders' equity, which then flows to the balance sheet. Now, imagine the company made a mistake. They declare instead of expensing item, they put it on the balance sheet as property, plant, and equipment, let's say. Now, when we do the change, moving the assets into the expenses, if we have recorded this expense in the first place, that will naturally reduce the net income. Now, the question is, if we find that mistake, how can we fix that mistake? Now, we're not going to go back to restate the net income, but we're going to see where the net income goes. And since we know that the net income goes into the retained earnings, we're just simply going to go and change the retained earnings to reflect the difference. Means that to reduce the retained earnings to reflect the flipping the assets into the expenses, which will reduce the net income, which naturally is going to reduce the retained earnings. Make sense? That will be a retrospective approach for accounting for the error or changes in the accounting policy. we're not changing the net income, we're going directly to the retained earnings and we're changing the retained earnings, which is naturally the same. The other option is prospectively. Prospectively is moving forward. From now on, we're treating this event this way. Up to this point, it doesn't matter how we treat it. We did what we did. From now going forward, we're only going to do this. That means prospective versus retrospective. Now, example for the accounting errors can be the corporation recording the closing inventory balance as 30,000. The correct amount was 40,000. Now the error resulting overstating the expenses and understating the net income. So again, the closing inventory balance is recorded as 30,000. That means we already expensed the cost of goods sold. However, the right amount for the inventory is not 30, it's 40,000. So basically, we naturally put more expenses. We overstated the expenses with $10,000. And we're thinking how this is going to affect the income. Obviously, the income is going to go down with, went down with 10,000. Now we have to correct that one. So what that means is we have to take out from the cost of goods sold 10,000, which is going to reduce the cost of goods sold. That's going to increase the gross margin. And that's going to increase the net income with the 10,000. But we're not going to change the net income. We're going to go and see where the net income goes. The net incomes go to the retained earnings. For that reason, we're going directly to the retained earnings and we're increasing the direct retained earnings by crediting retained earnings and increasing the inventory with the 10,000. Now, what's going to happen if we do that? Our retained earnings in the beginning was 390. Now we have adjustments to correct the errors, which increase the retained earnings with 10,000. So the new retained earnings now adjusted is 40,000. Net income for the period is the net income. With that was happened in the previous period, 2022. The net 2023, there's no changes to that one. The dividend that we paid 2023 is the same, and the retained earnings now remaining at the end will be $10,000 more compared to the previous one. On the International Financial Reporting Standards, I already told you at this point, I'm not going to spend time for this comparison. We're going to spend more time on the intermediate financial reporting when we have to go over the International Financial Reporting Standards. Once you get understanding of the International Financial Reporting Standards, then we're going to start doing comparison with the accounting standard of the private enterprises, which this course is under, and the International Financial Reporting Standards. Now, the example of the consolidated statement of earnings and comprehensive income, this is for the under International Financial Reporting Standards. And the International Financial Reporting Standards, there is no such a thing as an income statement. Income statement is called consolidated statement of earnings and comprehensive income. There will be a new terminology, but once we go to International Financial Reporting Standard, then you're going to see new terminology. At this point, you just have to know that there's a change in the names of the income statement versus consolidated statement of earnings and comprehensive income. And that's about with this missing part for chapter 14. Now we can jump to chapter 15, and we're going to start dealing with the other part of the right side of the accounting equation. So if the accounting equation, let's leave one empty slide here. Let's put one slide here, right here. And let's do this. Again, as we remember, the accounting equation. Let's make it bigger. we already know that the asset is equal to liability plus equity. And so far we talk about the equity and we find out that under the equity section, we have the contributed capital. And on the other hand, we have the debt. Now we're gonna start dealing, since we're done with the equity, we're gonna start dealing now with the liability. And in the liability part, we're gonna see that we have here current liability, which will be the part of this course, with this class today, on the current liability and long-term liability. So this is for the liability here. This is for the. So today we're going to talk about the current liability, and starting next time, we're going to start talking about the long-term liability. Let's go and see what's a liability first. Now, in the liability, obviously, is another source of assets. As you can see, assets or the capital of the company comes from two sources. One is from borrowing, which is liability.
Professor, excuse
Yes,
me, Professor. I don't see your slide.
you don't see my slides?
Yes,
Because
Professor.
maybe I forgot to share my screen. Thank you for telling me. How about now?
No.
There we go.
Yeah, that's it. No.
Okay, thank you. Can you see it? Everybody see the slides now? Can everybody see the slides?
Yes, Professor.
Yes,
Awesome.
Professor.
Let's start again then. Again, the basic accounting equation was asset equal to liability, but not that liability, capital liability plus equity. Now, what we see so far is we saw so far that under the equity, we deal with contributed surplus, contributed capital, and retained earnings. Now, under the contributed capital, we have a preferred share, common shares, and we may have a contributed surplus. On the retained earnings, we're going to have here, let's do this. So here, under the contributed capital, let's do it small things here. Let's bring it small so we can have space. Or I can have space here. Let's go to 18. Now we're going to have preferred shares. We may have common shares. We can have contributed surplus related to the preferred share common shares. In the retained earnings, we're going to have a plus that will be here. In the retained earnings, in order to get the retained earnings, we have to add the net income for the period. We have to deduct the dividend. And we're going to get the new retained earnings. If there's net loss, we have to deduct the net loss. Now on the liability section, once we come to the liability section, we're going to see today we're going to have current liability. And we're going to have a long-term liability. Again, long-term liability. We're going to start dealing with this long-term liability next time. Today we're going to focus on the current liability only. Now, what is current liability? As you can see, current liability in the whole big picture of the company is another source of assets. Assets or the capital of the company comes from two sources only. One is the borrowing, the other is the investment. If we borrow money, that raises the liability for the company or the entity. If we invest, that gives the rise to the company now owes money to the investors. In both cases, the company owes money. Now, what's the difference between the lenders and investors? Investors are insiders for the company, where the lenders are outsiders for the company. Or maybe both are outside of the company, but here they are owners, part of the owners of the company, where the borrowers, lenders are just outsiders. Those two, they chase in different form of return. Investor can get access only and only to dividend, where the lenders, they chasing interest. That's the difference between those two sources of assets. Not source of income, source of assets, source of capital. That's why when company says, I want to raise some capital, either they have to borrow from the bank, either they have to issue common shares or preferred shares. There's no other way to raise the capital. So let's see now the first form of raising capital can be current liabilities. What is the current liability? Now, what is the liability at itself? Liability, it's very interesting in the definition. In the definition, the liability has all three forms of time. We have past, we have present, and we have a future. What is the liability itself? Liability is current obligation for something that we have done in the past and we have to settle in the future by either with financial resources or non-financial resources. So again, liability is current obligation for something that we did in the past, which we have to settle in the future. Simple example will be today, I owe money to Fido because I use the Fido services for my cell phone, which cell phone I have to pay by October 20th. So do I have a liability? Yes, I do. Why? Because I still haven't paid for the telephone services that I already used. If I have paid, there will be no liability. Now, that's why the liability is generally a current obligation. Now, what makes it current is because it's due within 1 year or company operating cycle, whichever is the longer. So we have two things that we have to compare. We have a 1 year, which is 12 months or 365 days, or operating cycle. And the definition is current liability is the liability obligation of the company, which is within the 1 year, or the current operating cycle, whichever is the longest. If the 1 year is longer than operating cycle, that means 1 year. If the operating cycle is longer than 1 year, 365, then it's operating cycle. Now, the definition for the long-term liability is very simple. If the liability is not current, it's long-term. So what we're doing is basically we're checking only is the liability current. If the answer is if it's within 1 year or current operating cycle, whichever is longer, yes, it is. If it's no, it's directly long-term. Now, what will be the liability? First liability comes from the normal operation of the company. Company purchase inventory or purchase supplies or whatever they purchase during the normal cycle of the company, and they haven't paid yet. We call that purchase on account, which is usually due within 30 days. Is the company going to pay within 30 days? That's a different question, but we're not going to go that far. So the company purchased, in this case, inventory on credit or on account. Then what we're going to do, we're going to get the inventory and we're going to show the liability for the inventory that we just purchased. So that will be debit inventory, credit accounts payable. Once we pay the supplier for the inventory that we purchase, then we have to reduce the cash in our company and close the accounts payable. So that will be debit accounts payable, credit cash. I hope you don't have problem with debiting cash and specifically by purchasing something on account or on credit and later on paying that. Now that will be for the purchasing of inventory or any office supplies or anything which is related to the normal operating cycle of the company. The other thing that we can do, the other short-term liability, can be a borrowing from the third parties. In this case, now instead of giving a raise for accounts payable, we're going to give a raise to something else, which this case is called short-term note payable. So we're purchasing again, we can still purchase the inventory, don't get me wrong here, but we're going to give the short-term note payable means a promissory note that we're going to pay the supplier in this case, if we purchase the inventory within 1 year. So this company purchased inventory costing $16,000. Now, compared to the accounts payable, on accounts payable, we don't owe interest. But on the short-term note payable, we might owe interest. In this case, we have to pay 10% on the note payable. So again, on the day that we get the inventory and pay with the short-term note payable or the promissory note, we're going to do debit inventory, credit, short-term note payable. And we have our liability and we have our assets. Both increasing in the same amount, we are in perfect balance. Now, at the end of the first year, now we have to see when we gonna pay that interest, right? So since this one is 1 year not payable, let's see which is the date available here. On October 31st, 2002, right? Now, what we have here, interesting, is that October 31st is the day that we issue the note payable. Then we have December 31st, which is the year end of the company. And then we have another date, which is October 31st, 2003, which we have to pay that note payable plus the 10% interest. Now the question is, at the year end, do we have to prepare financial statements? Natural answer will be yes, we have to. Now, if we have to prepare financial statements on December 31st, do we owe money to somebody because in the past we borrow money? The answer is yes, we do owe money. In fact, we owe exactly, in this case, in this case, we owe exactly $16,000, which is the note payable. So on our balance sheet on December 31st, we're going to have a note payable for $16,000. The second question is, okay, we have the note payable sitting on the balance sheet through this general entry which we made on October 31st. The second question is, since we're using accrual accounting, and since we have to pay 10% interest on the 16,000, which is 1,600 for 1 year, once we're preparing the financial statement December 31st, do we, on December 31st, do we owe interest for the period that already passed? Now, what we can do is think about it. Okay, I borrowed the money on October 31st. Now I have to pay the note payable 1 year later. And 1 year later, I also have to pay the interest. Up to December 31st, did I use the money? Yes, I did. Do I owe interest? Yes, I do. Do I have to pay that interest later? Yes, we do. So, do I have to show the liability for the interest that I owe for using the money for November and December? Yes, we do. And what we're going to do, we're going to record, we're going to calculate the portion which is related to the months that already expired up to the year end. And we're going to show on the financial statements our obligation for the interest that we owe for the note payable that we have to pay on October 31st next year. So the $1,600 that we owe for the entire year, we're gonna split it by half. One half will be from the date of the borrowing up to the reporting date. And the second part will be from the reporting date up to the payment date. Then that's gonna reflect our journal entries. First, we're gonna have a journal entry at the year end to accrue for the interest that we owe, but we haven't paid yet. So we're going to have debit the interest expense for the amount of 267, which is the 2 months fraction from the amount of 12 months for the $10. And that's going to go to the interest payable. Now on the balance sheet, we're going to have two payable. One will be not payables, short-term not payable, and interest payable related to that, not payable, short-term not payable. Then on the payment date, which is going to be October 31st, we're going to pay for the not payable, which is 16,000, and we're going to close the not payable. Also, we have to pay for the interest, which is $1,600. But hold on a second, we already show the interest that we owe for the first 2 months. So we have to close that accounts payable that we created on the year end for $667. And then, but that's not enough because our interest is 1,600. Well, the other portion, which is from January to October 31st, that will be the interest expense for the period of January 1st to October 31st next year, or the year that we're doing the payment. And that will be our entry. So basically, once we compute the interest payable plus interest expense, we're going to see that the number here is exactly $1,600. Now, what else? What else the other payable is going to come? They're going to come from the short-term bank loans, which are similar to the short-term note payables. They can be for the fixed period, or and we can negotiate the interest rate. We can borrow from the line of credit with any institutions, or even at the personal level. You may have a line of credit, which you can borrow the money, and once you're paying back, you pay the principals and pay the interest. What's the other thing that we can see as a payable? The other payable is going to come from the goods and service taxes, or as you already know it, GST. We may see it as a harmonized sales taxes, which is HST. So basically, if we are in province of Toronto right now, we're going to talk about HST. And we may have a sales tax payable. Goods and service taxes, GST, harmonized taxes, and sales tax payable. The two basic consumption taxes on every purchase in Canada. One is the GST, or goods and service taxes, which is paid to the federal government. It's 5% and sitting 5% for the long period of time. Since I came to Canada, that was 2003, is still 5%. And that 5% is mandatory for every province within Canada. Then we have another level of consumption taxes. Those are consumption taxes, or kind of direct taxes. That will be the provincial or indirect taxes, maybe indirect taxes, yes, because you tax not on the income, you tax on the purchases. So that's called provincial sales tax. You know, there's services are excluded from the provincial sales taxes, but there are some goods on which we have to pay provincial sales taxes. If you check your receipt, once you shop for shoes in any store in Canada, at the end of the receipt, you're gonna see the purchase price, number of the items you purchase price per item, total, then you're gonna see GST, or you actually you're gonna see total taxes, that much, total amount due. And later on, you may see breakage of the total taxes into the GST portion, which is required by the provincial government. So you can have a clear idea how much is the portion of the GST or goods service taxes and the provincial sales taxes. Now, the provincial sales taxes are different from different provinces. And then we have the harmonized sales taxes, which is HST. Harmonized sales taxes combine both GST and PST together, and that's directly submitted to the Canada Revenue Agency. In the provinces that don't have the HST, the Canada Revenue pays the PST portion to the relevant province governments. Actually, that's on the harmonized taxes. When we have the goods and service taxes and provincial taxes are paid for the provincial level government, and the goods and service taxes are paid to the federal level government, which is Canada Revenue Agency. Now let's see the sales taxes and provincial taxes. As you can see here, in Alberta, there's only GST. There's no PST, there's no GST. In British Columbia, we have 5% GST and 7% PST. In Manitoba, same thing. In New Brunswick, we have 15%, which is related to 5% is the portion of the GST, because that's a national retired country. And the remaining is the portion of the provincial sales tax. As you can see, those territories, which are small and Far East, they're paying more taxes than we pay here in British Columbia, or the taxes they're paying in the Alberta. Northern territories, again, only 5%, there's no PST. Nunavut, 5%, no PST. Ontario pays 30%, which comes from the 5% GST and 8% PST. Prince Edward at 15%. Quebec pays 5% GST, and provincial taxes are 9.975, which is a Quebec sales tax, not provincial sales. Now, the Quebec is, as you already know, they want to be a separate country, but they want to use everything in Canada. So that's why the terminology there a little bit more related to Quebec. Saskatchewan, as you can see, the provincial sales taxes are less than British Columbia and Manitoba, it's only 6%. And in Yukon, there's no provincial sales tax. So from those provinces, as you can see, the Eastern Territory, Eastern provinces, they paying relatively high percentage of taxes, consumption taxes, 15%, where the Pacific, Central and Pacific territories are relatively lower. The lowest is in Alberta 0. Why is that? Because the Alberta earns more of the contribution to the province from the oil company by exploring the oil sands. Now, how the GST actually works? The GST is very simple. For the corporation or the entity, which are entity, every time when the entity sells goods and services, they have to charge GST on sales. Then the GST is collected by the seller or the entity on all the taxable goods and services. They're recorded as a GST payable because those are money that doesn't belong to the company. The company temporarily have those money, but they are they're government money, federal government money. So we're using the corporation, the government using the corporation or the entity as a mailbox, which temporarily collect the money from the sales and then have to forward it back to the government, Canada Revenues Agency. Now, every time when the corporation or entity purchase, it has to pay the GST as well. So that's GST, which the corporation or entity pays, is recorded as the GST recovery. Also is called income tax, input tax credit. Sorry, not income, input tax credit. Now that is a current asset compared to the GST payable, which is current liabilities. Now, at some point, the company has to figure out what to do with those because now we start accumulating the GST payable on one side, which is liability, and GST recoverable on the other side. At some point, the company has to do compare those two numbers, see which one is higher, what's the difference between one and the other, and then either submit or remit the difference to the government or ask for refund from the government. When the company has to, or entity has to remit the GST to the government, when the GST payable is more than the GST recoverable. When the company can ask for refund for the GST that the company paid is when the GST recoverable is more than the GST payable. Now that brings to the question, is it possible company that earns profitable company to end up with the GST refund? The logical answer will be no, unless the company works in the business that dealing with the exempt on the GST sales. That will be the only option that we may have. So how this gonna work? Then let's assume the business that operates in the province without PST. We know in the PST factor here. We purchased the sound system of the computer for $2,400, and we paid $120 GST. Then we paid $100 for advertising plus the $5 GST. Then we earn revenue from the customers for $4,000, and we charge the customer $200 GST. How do you want me to do this? Go over the slides, or we do the generating on the Excel spreadsheet? What do you prefer? Can you guys hear me? Hello?
Prof? Yes, Prof.
Yeah. How do you want me to deal with this? Just keep going with the slides and check the journal entry on over the slides, or you want we to create a journal entry on the Excel spreadsheet?
Can you create the entries, Prof?
Yeah, I can do that.
Thank you.
Okay, let's go. Let me copy this, and I'm gonna move to the Excel. Just give me a second to open my Excel spreadsheet. Make it a little bit bigger. What's the question? Okay, I have it. So let me share my screen. Can you guys see my screen?
Yes, Prof.
Awesome. Now let's go. First one. Let's purchase the sound system equipment. Once we purchase the equipment, which account we're gonna debit? Give me some option here.
PPE.
Property, plant, equipment, aka equipment, right? Equipment with $2,400. $2,400. Then now we have to record the GST. Now in this case, since we're the one who paying the GST, we're gonna ask the government to pay the GST back to us, since we're not the final consumer. So that will be debit, GST recoverable. And the GST recoverable in this case will be
120.
$120. Now, let's pretend we're paying everything cash. Now we need credit, right? Which account we're gonna create now?
Accounts payable.
No, let's pretend we're paying everything cash.
Cash.
Cash. Let's go with
Yeah.
cash. Let's make it simple. One is debit, the other one is credit. So credit, cash, and we're gonna pay the entire amount, correct? Just to be in balance. Make it simple. Just some adjustments here. Boom, boom. Go to this one plus 1,000 cash. Okay, next one. We paid for advertising.
Advertise.
Debit. Advertising what?
Expenses.
Expense.
Expense. Don't forget the expense, right?
Yes.
So then we're gonna debit another account, which is the GST recoverable. We pay here $100, and here we have $5.
Five.
And let's do this credit again. Credit $105.
100.
Now let's do the sell. Now we're selling. We earn this money. Let's pretend again we're collecting the cash.
Collecting the cash.
Debit. Cash.
Cash. Accounts receivable.
Cash. So now we don't know. We don't know what the amount is. We're gonna see. Now, why we get the cash? Because we sold something and we earn the revenue, right? So which
Yeah.
account I'm gonna create?
cash.
Cash, you already debit cash. If I create cash, put cash, then I'm 0, 0. I'm earning money now. I'm generating.
Earning money
What?
now, so it's under
Right. What will be the sales revenue, right?
sales revenue, like yeah, sales revenue or account receivable, diba?
Okay.
Right.
Now, no accounts receivable, cash. We're
Oh.
collecting it,
Okay.
right? Once we collect it, there's no accounts receivable. That's why I
Okay.
want to skip it simple.
Sales revenue.
We're collecting the money. And okay, so that will be the cash sales revenue is $4,000. But we also have a GST. That will be credit. We have to create GST payable. So that will be GST. Since we're collecting it from the client, we have to pay it to the government. Then we're gonna see that one will be $200. So now cash that we collected, it's gonna be equal to the 4,000 plus the 200 or 4,000. Now the end of the month comes. Now what we can see, we have GST recoverable 2 times, right? We have 120, and then we have another, we have $5.
5.
Then we have GST payable. And that GST payable is 200, right?
I want to see the bear so bad, but it's so far. I forget.
Me too.
No.
Okay, so what we're gonna do, we're gonna see which one is higher. So if the recoverable, we have to ask the government. If the payable, we have to pay to the government. Where we are at this point, which one is higher? Recoverable or payable?
Payable.
Payable. How much higher is the payable?
75.
It's equal to this one minus that one. $75 more. So what we're gonna do now? We have to pay it to the government. How are we gonna pay it? Obviously, cash. Now, once we do the cash, which account we're gonna debit?
GST payable.
GST payable. Payable with $75. And then we're gonna credit. So sorry, this missing the debit here. That's the debit, this one, GST payable, and then we're gonna create cash because the government was our cash with $75. So what's happened in that case? Now we have same situation, but a little bit different because we're gonna have here 120. Then we're gonna have those 5. 125 is the total. But I want one line here, and then I have GST payable. GST payable, first I have 200. And then I have negative 75. So where's my total? On one side I'm 125, on the other side 125. So I don't owe the money to government. Government doesn't have to pay me back. I'm square and fair with the government. Make sense?
Yes, Prof.
Now, how often we have to do this? When you start working in the company, how often you have to do this calculation? the government's gonna tell you. Some companies have to do this calculation once a year. Some companies have to do this calculation every quarter. Some companies have to do this calculation every month. What's gonna determine what will be the reporting period of reporting at the GST? The sales. If the sales are a relatively small amount, then it's most likely the company is gonna fall into the annual GST return. Or that will be the declaration. And they have to report the GST once a year. If the revenue reach some amount, I believe it's more than 1 million, the entity is gonna move to, the government is gonna move you to the quarterly GST reporting. So every quarter you have to prepare the report, the GST, calculate how much is the GST recoverable, how much is the GST payable, see the difference, submit the difference, end of the story. If the revenue will reach, I believe, 5 million. Once the revenue reach 5 million, you most likely want to move to the monthly GST return. In that case, the government wants to collect the GST as soon as possible. Also, this is the thing with the GST. Let's label this spreadsheet here. GST, and let's go back to the slides and repeat everything that we saw here through the slides. Let me share my screen with the slides. And let's repeat everything again. First thing first, here we purchased the equipment. We recorded the GST recoverable and we paying cash. Second, we use the advertising expense. We record the GST recoverable and we pay in cash. The last transaction, we provide the service revenue. We charge the client the GST 5%, and we collected the service revenue and the 5% GST. Once we do that, we're gonna start checking. Okay, I have GST payable. I have to pay to the government $200 for the sales of 4,000. But the government have to pay me $125, which is the GST I paid to the vendors which I'm purchasing. The difference is $75 in favor for the payables. So I have to pay the government $75. So what we're gonna do in this case, GST. So in this case, as you can see, what they're doing is they're closing all the accounts to zero. They're closing the GST payable with $200, GST recovery from $125, and cash with $75. That will be another way. The other way will be just simply the offset, the difference, the way I show you the journal entry. Now, for the purpose of Pearson, stay with this journal entry. Okay? Bring the balances in both accounts to zero. Now, what's going to happen if we're working in the province with harmonized taxes? Nothing scary, we're just going to combine the both taxes. So in that case, instead of charging 5%, we're going to start charging 13%. And at the end of the period, again, we're going to check how much is the HST payable and how much is the HST recovered. And we're going to pay the difference. Obviously, in this case, the cash that we have to pay will be more. Why? Simply because we're charging more GST on sales. In this case, 13% versus 5%. As you can see, the revenue is not affected. Expenses for the company are not affected. The equipment is not affected. What is affected is the money that we're collecting from the customers for the government and the money that we pay to the vendors for the purchases of the items that we need for our operation. Now, with the provincial taxes, that's a little bit more different. Provincial tax is kind of different animal. What that means, again, we're gonna charge the final consumer of the product. Typically not, this is not levied on sales to the wholesale or retailers. And it's considered to be end user tax. Now, PST charge will be recorded as the sales tax payable. And it's a current liability. PST paid, those are not recoverable to the business. And those are added to the expenses or to the amount of the property, plant, equipment asset, if we have that asset. That's the tricky part with the PST. In the very, very small instances, you might be able to recover the PST and offset against the PST payable. So for that reason, the PST is completely different. If you end up working with a company that charging the PST and showing the GST recoverable, be very careful, please. And in that case, one heads up is you can recover the GST, the PST, only and only if you directly charge the PST for the exact same item. For example, if I'm buying, if my business is a retailer which purchasing computer with PST and I'm selling the computer with PST, I will be able to offset the PST payable and the PST recovery. In any other cases, the PST is going to come back, it's going to come to me as a cost of the business. I know it's not fair, but that's how it is. So be very careful if you have to deal with the PST. Now, the long-term debt, what's interesting with the debt is the debt, which is due more than a year, is long-term. But imagine this. I owe $30,000, which I have to pay every year $10,000. So how can I present this liability on my financial statements? Well, looking at the reporting, date, I'm gonna look forward and what I'm gonna see. On the big picture, I owe $30,000, which I have to pay every year $10,000. So that means that the first $10,000 that I have to pay, they are within 1 year. So that makes them automatically current liability. The other 20, which are due for more than a year, that's a long-term liability. So then I'm gonna have from the $30,000 that I owe within 3 years, I'm gonna have two portions. One will be related to the current liability. The other one will be related to the long-term liability. That was the first year. Second year, I already paid the first $10,000. Now I have to pay another 20. But on the reporting date, when I look forward, the first 10 I have to pay within the year. So the first 10 will be current liability. The second 10 will be long-term liability. So my liability is going to have two items, current liability, long-term liability. Total will be 20,000 on the second year. But it's going to be portion of the current 10,000, long-term 10,000. On the third year, at the end of the second year, once they pay the second 10,000 and they have only 10,000 left, the reporting date at the end of the second year, looking forward, I'm going to see only one payment of $10,000 within 1 year. So then my total owing is 10,000. Now we're going to have only one portion, only current liability, 10,000. Long-term liability, I don't own anything more than 1 year. So that's an interesting part when you're presenting the long-term debt on the financial statements on the balance sheet for the liability. Always the long-term debt always going to have a current portion which has to be paid within 1 year and long-term portion. Don't forget that, please, for the presentation purposes. So in this case, the current portion of the long-term debt is the amount of the principal that is payable within 1 year. That does not include any accrued interest payable. Journal entry in this case is not required. Everything is about presentation. Then we're going to the accrued expenses. What is accrued expenses? Accrued expenses are any expenses which we used, but we haven't paid yet, or obligation for something that we are done something in the past, we are liable and we have to pay in the future. Those are treated as a current liability or accrued liability. In this case will be the on the not payable when previously we did the not payable, that will be the interest payable. For the period that we use the not payable, when we have the reporting date, then we have to accrue that interest payable. That's why we'll be very careful when you're preparing the journal entries. Always remember, we have a date of the transaction or recording date, and then we have a reporting date. Now on the recording date, we record the transactions which actually happen. Where on the reporting date, we're doing the adjustments for something that hasn't happened yet, but we have to consider because we're running accrual-based accounting. So that's why we're doing the accrual expenses. And that's why we're accruing the interest payable, we're accruing property tax payable, we're accruing the salary payable, and we accrue any payroll liabilities, which is related to the Canada Pension Fund or employment income or extended health to the employees, or vacation payable, which we own to our employees at the reporting date. Next thing that we have to consider is any unearned revenue. Now, in this case, you can ask me what's the difference between accruals and unearned revenue. Now, in the big picture, unearned revenue is deferred revenue. What means deferred? Deferred means pushing the event of recognition into the future. What that means? That means we collected the cash, but we haven't recorded the revenue yet. Then what's the difference between the deferral and accrual? In accrual, the cash hasn't happened yet. The cash going to happen in the future. Where in the deferral, cash already happened. But we're pushing in the future the recognition of the either expense, either revenue. In this case, a non-revenue, that will be the revenue. Now, when we accrue the expense, we have obligation to pay it further. That creates a liability. When we collect the cash, and push the revenue in the future, that could also create a liability. Because technically, we haven't provided any services. The fact that we collected the cash from the customer, it doesn't change the fact that we haven't delivered anything yet. And the customer may come and say, you know what? I want my money back. And we have to pay the customer the money back. So technically, until we deliver the service, any cash that we receive from the customer, we are liable. Either we are liable to pay the cash back, either we are liable to provide the service to the client. That's why it's called liability. Example of the liability can be a gift card, or concert ticket, or airline ticket, or a tuition fee for the courses. All of you have to pay the tuition fee before the start of the semester. But hold on a second, I haven't received anything yet. So whatever money the Alexander School of Management collected from you, that is unearned revenue. Why? Because they haven't provided services. Also, you may ask for a refund. That's why the first week, usually the first week of any institution, education institution, the first week you can get a full refund. Why? Because you're testing, you work there in the classroom, testing the teacher. Well, I don't like this teacher, or I don't like the subject, or I don't like the classroom. I want my money back, or I want to switch to another course. And you should be able to do it with 100% refund. After the first week, then become a little bit more difficult. Why? Because the delivery of the service already started. Let's keep going with the unearned revenue. Again, unearned revenue, remember, we already received the cash. So on September 3rd, subscriber paid $20 Rogers Media for annual 16 issue subscription. Now, Rogers, what they're gonna do, they're gonna get the cash, obviously. They're gonna collect the cash right away. And they're gonna show obligation to provide service or deliver the goods in the future, or pay the cash. Then on the reporting date, they're gonna check adjusting entry on December 31st after 4 issues has been delivered to the client. Then we have to account with whatever delivered. So 16. So half is 8, the other half is 4. So basically we provide 45% of the services. 45% of the services of over $20, that's $5. That's why we have here. We earn revenue for the $5 and reducing our liability to provide the services because we already provide the services with the same amount. Now, what's going to happen if the customer come to the company and give a deposit as a security? So, for example, I want to purchase a car. The car dealership says, okay, but you have to, in order to consider you as a customer, you have to give a deposit, $5,000. Is that $5,000 obligation for the company to the customer? Absolutely. So the company must refund the cash to the customer under certain conditions. So also when the customer, there's this contracts or let's say projects for which different company provide they provide the different offers to that contract. But in order to be able to be on that particular stage, you have to pay a deposit, which if you don't win the contract, that deposit is paid back to you. So those are the customer deposits payable that we might see in the practice. Now, let's see which accounts current liability has to be estimated and why they have to be estimated. Now, the current liability sometimes has to be estimated. Why? Because we know the liability exists, but we don't know the exact amount. So in that case, we cannot simply ignore the liability, and we have to find a way to come up with a reasonable estimation in order to record the liability into the balance sheet. Which are those instances that we may have such a liability, which we have to show on the financial statement? That will be the warranty, vacation payable, income taxes, or contingent liability. Now let's go one after another. First, we're gonna go with the warranty payable. Before I start with the warranty payable, I want to ask you, how do you feel so far? Any questions so far?
Thank you.
Do you guys want a break, or you want me to keep going?
Yes,
No
Professor.
questions, Prof.
Break.
Break,
Break?
Prof.
Break,
Yeah,
Professor.
Okay.
break, Prof.
How long?
20 minutes.
20 minutes. Oh my goodness, man.
Okay,
No,
10 minutes.
15?
10 minutes. 10 minutes more reasonable. 15 is too much.
Okay. Yeah.
You pay a lot of money to
Yeah,
study,
that's true.
right? So 15 minutes, that will be waste of money, too much waste of money.
Okay, 10 minutes.
Okay, 10 minutes. Okay,
Thanks, Prof.
thank you.
Thank you, Professor.
You know what? I'm trying to value your money.
Thank you. Prof, I'll send you an email.
Okay,
Because I request something to you, but I didn't get an answer. So if you want
Okay.
me, I can just resend it.
please, yes. Where are you
Yes.
sending it? Where you send? In
I
Moodle?
sent it. Yeah, I sent an email like 2 weeks ago. You answered me, and
Okay.
after that, I answered you, but I didn't get the answer for the second email. But
Ah,
don't worry, I
okay.
can resend it again.
Please,
I just
yes,
wanna
let's do
see
that.
I just wanna know
The answer for that question. Okay.
yeah, I mean the availability that you have for that question. Thank you, Prof. I will resend
You
it
are
right
Katya,
now.
right? You're
Yes.
Katya.
Yeah. But I resend it
So
again. Don't
listen
worry,
this.
Prof.
So listen this. What day you are in campus?
I'm on campus on Mondays.
Only.
Only on Mondays, yeah. But that's why I'm asking if you have
So
like
where
another.
you living?
I'm living at New Westminster.
New Westminster.
Mm-hmm.
Okay. Okay. Let's exchange emails then.
Yeah, of course. Thank you, Prof.
Okay. Let's keep it private.
Yes, of course. Thank you, Prof.
Okay. All right, you ready?
Yeah.
Yes,
Yes, Prof.
Prof.
Okay, then. Let's continue with this estimation of the warranties. Let me share my screen again, and let's continue with this. Now, first estimation is the warranty. Why do we need to do estimation for the warranty? Simply because we don't know the amount of the warranty until the warranty actually happens. However, the warranty comes with the sales. If I sell laptop, that laptop comes with a 2 years warranty. If I don't sell the laptop, there's no warranty. So when they have to record the warranty. Now, general rule says in accounting, we have to match the revenue with expenses. In that case means if I sell the laptop and I provide a warranty, which might happen, I have to record that warranty at the sales day or at the time of the sales or at the period when the sales happen. So if the period happen, if the sales period is the current year, that means I have to record those warranty expenses in the current year. But I don't know how much the warranty is going to be. Because again, the warranty only going to happen if the client comes back and asks for repair or ask for replacement. So how can I record something which I know I have to record, but I don't know how much it's going to be? Well, simply what we have to do, we have to estimate the warranty. Do our best estimation to come up with the amount, which amount we can record as the warranty expense and show it as a warranty liability. Because technically we owe to the client within the 2 years warranty. So the example will be, this company has sales of $80 million. Sales are subject to 1 year warranty. Company believes, so how can we come up with the estimates? Based on the belief of the company or based on the previous experience of the company from the previous years. If there's no previous years, then believe. I believe I'm providing a very reliable product, which 1% of the sales will be enough to cover all the warranty within 1 year. That may happen. So the company says, okay, 1% warranty. It's appropriate estimate for the cost of the warranty. Now we have to do the journal entry for those 1%. What will be our journal entry? First, we have to show the sales. And in this case, the sales are not on cash. We did not receive the cash yet. It's accounts receivable. So our sales are $80 million sales and $80 million accounts receivables. 1% of the $80 million, that's 800. So we have to record now the warranty. And what we're going to do, we're going to debit warranty expense for the amount that we haven't paid, but we think we might have to pay. And in that case, since we might have to pay, we have to show as a payable. But in this case, will be estimated warranty payable. And we're done with this. Now, later on, during the year, the actual repair for the sales that we made for $80 million come up with the amount of $700,000. If we're repairing the defect merchandises, we have to pay cash for our employees to do the repairs. Now, in this case, since we already record the warranty expense, we cannot record another warranty expense. Then how are we going to treat this? Well, then we're going to reduce our estimated warranty liability. So we're going to reduce the estimated warranty liability with $700,000, and we're going to pay cash to our employee to do the repairs. Or we may have to replace the production or whatever we sell to the customers. In that case, we have to take it from the inventory. Again, we're going to reduce the estimated warranty payable, and we're going to give them new items from our inventory, and we're going to reduce the inventory. Now, as you can see, we're going to have warranty expense for $800,000 and the actual payment for $700,000. What that means that the estimated warranty payable account, we're going to have a credit balance of $100,000, which balance is going to carry forward for the next year. And the next year, again, we're going to do the estimations with our sales. Once we do the sales, we're going to record the warranty. Once we pay the warranty, we're going to reduce the payables, estimated warranty payable, and keep going. That's basically what's happening in the company. Later on in the different courses, we're going to see the implication of this estimated warranty payables and estimated warranty expenses. The other estimation that we have to do as an accountant at the end of the reporting period is to estimate, is there any vacation that we owe to our employees at the reporting date? We may have some days outstanding for our employees if there's no requirement from the company to use all the vacation within the current year. In that case, that vacation, it has to be estimated and accrue in the same period that the employee working and earning their vacation time. So how are we going to do this? On January payroll is $100,000. Now, since you are the accountants and you're going to continue with the accounting, the vacation is governed by the Basic Employment Standard Act. Basic Employment Standard Act says every employee, after 1 year of employment, is entitled for 2 weeks vacation. After 5 years of employment, the employee is entitled for 3 weeks vacation. And that's why the Basic Employment Standard Act stops. So in some companies, you may see 3 weeks vacation, and that's it. Even if the employee works 25 years, 3 weeks vacation. Why? Because the company follows Basic Employment Standard Act. End of the story. So, if the employee is entitled for 2 weeks vacation, that equal to 4% vacation on every dollar earned. So every time when you see 4%, vacation, that means 2 weeks vacation. 6% is equals to 3 weeks vacation. 8%, obviously you can guess it's equal to 4 weeks vacation. But I want you to know those percentages because those percentages are not some random percentage. Those are related to the weeks of vacation time. Now, again, let's go. Payroll is $100,000, 4% is related to the vacation. So the company in January, the company record vacation payable accrual, vacation pay expense, estimated vacation payable $4,000. Now, when the actually employee in August, the employee with the monthly salary for 2,000 takes a 2-week vacation. Now the entry to record that one will be the various accounts in the cash will be 2,000. We're gonna pay the employee 2,000 plus deductions and everything that we have to do that. We're gonna take 1,000 from the vacation liability since the employee using the vacation. And the rest is gonna go to the salary expenses. So once the vacation is earned, we're gonna show it as a vacation expense, estimated vacation payable liability. Once the vacation is used, we're gonna reduce the estimated vacation pay liability and we're gonna pay it cash. That's the general idea. It's very, very similar to the warranty expense and estimated warranty liability. The next accrual for the payables is the income tax payable. Now, corporation, every corporation is required to pay taxes. What's the percentage of the taxes you're gonna see in the tax course? That's a second part of the course, which is chapter, I believe, chapter 12, 13, 14, that's dealing with the corporate taxes and what's the percentage and what kind of taxes the corporation has to pay. Now, as soon as the corporation start earning income, the corporation is required to pay taxes. Once the corporation earn income, taxes. Now, what's going to happen on the next year? Next year, the government's going to ask you, Canada Revenue is going to ask you to minimum to pay the taxes that you paid the previous year. But you may say, "But hold on a second, I haven't worked yet. How do you know that I'm gonna have to pay taxes?" Well, the idea is that corporations are open to earn money, means to generate income. And once the corporation generate positive income, naturally the next year, that income most likely will increase. So in that case, the government gonna ask you, once you make an income, the government start to ask you, make installments on the following year, at least to pay the same amount of taxes that you paid the first year. So if for the corporation, if they're not paying taxes, tax installments means only one thing. They've been operating up to this point on loss, or this is the first year of operation. If they pay installments, that means they're profitable. So the installments are due during the year. Canada Revenue is going to tell you what kind of installments you have to pay. Most likely those will be monthly installments. Now, the entry to record the monthly income tax installments is going to be income tax expense, directly to income tax expense. If it's $100,000, $100,000, then Canada Revenue doesn't accept anything but cash. So you have to pay cash $100,000. Now, at the end of the year, obviously, if the corporation pays $100,000 every month, 12 months, $100,000, that's $1,200,000. At the end of the year, corporation calculates the actual tax expense, and they end up with $1,240,000. Now, they already paid to the government through the year, through the 12 installments over $100,000, $1,200,000. So now we're comparing. I already pay $1,200,000. I have to pay $1,240,000. So I still have to pay $40,000 more. Okay, let's pay it. And they pay now the entry is very simple. Then it's going to be income tax expense $40,000, income tax payable $40,000. That's for the $40,000 owing. Sorry, for the accrual for the dollars owing. And when we actually have to pay it, then it's going to be income tax payable 40,000, cash 40,000. And we're done with this income tax and income tax installments. Next one is contingent liability. Now be careful with this one. So now the previous one was provisions. Warranty is provision. Vacation is provision. Income tax payable is provision. Now we can move into contingency. Contingent liability is a potential liability that depends on something that might happen in the future, arising from something that already happened in the past. The future event may be a court case that will settle a lawsuit. That might be the other case. Simple example for contingency, I'm going to give you this. Imagine who will be that? Some soccer player now. The only two they're still playing, so I can still use them. Lionel Messi. Let's go with Lionel Messi. Now, imagine the Lionel Messi going back to Barcelona. He signed a contract for $30 million. He's not his prime age, so $30 million for one season. Now, but there's additional to the contract, which is some kind of conditional or contingent. And that may say, if the season, let's say the season have 50 games, if Lionel Messi starts in 45 games out of 50, he's going to get $2 million more. If he scores more than 20 goals within those 45 games or 50 games of the season, he gets another 2 million. Make sense? So we sign the contract, it's in the contract, but depends on something that's going to happen in the future. Now we have to calculate what's the possibility he to score more than 20 goals. And he is to play or start for more than 45 games to earn that additional $2 million. So this is the decision tree. Watch this carefully. First, we have to measure the level of certainty. Is it likely? Is it unlikely? So if it's likely, then we have to ask ourselves, can we measure it? It's likely to happen. Can we measure it? Yes, the amount can be measured. Then we have to accrue the expenses with the general entry. Now, it's most likely it's going to happen, but we cannot measure it. We cannot reasonably estimate it. Then we have to make a disclosure to the financial statements. Now, the next level is uncertain. So it's not like it can be measured, but it's definitely unlikely. In that case, we have to make only disclosure. But if it's unlikely and we cannot measure it, we don't have to do anything. If we cannot be determined, nothing. Oh no, actually no disclosure is required. Now, remember this because this is under accounting standard for the private enterprises. Later, and again in the intermediate accounting second part, 332, you're going to see something like this. But there will be a little bit differences. And that will be a difference between accounting standard for the private enterprises and the international financial reporting standards. Here, now it's a time to bring the ethical issues related to the accounting for the current liability and contingent liability. Now, depends on what the business wants. Some business wants to look profitable. Some business want to not look profitable. Why business may not want to look profitable? Because they try to avoid hostile takeover. Why the corporation wants to look profitable? Because they want to attract more investors. Different reasons, different things. So, if the business wants to look more successful, the owner and management may be tempted to overlook some expenses and liability at the end of the period and overstate the net income. So once we forget of some of the expenses and liabilities, that's going to give us less expenses. Operating expenses, that's going to increase the net operating income. We're going to be more profitable. If the business with contingent liability walk through to the between, disclosure is enough information and give away too much information. That's if we don't record it, but just put it in the notes, that means we're not recording the expense. If we're not recording the expense, again, the income goes up. So you can see, based on the management and what the management wants, there are some options for the accountants, but that creates that ethical problem. Is that ethical? And how can we deal with these ethical issues? Let's go with the payroll. Now, one of the outcome of this course is you to be able to do payroll if you're hired tomorrow. If some company hires you tomorrow, the first thing they're going to ask you, can you do payroll? That's pretty much the base, the main thing that the corporation is looking for, or entity looking for. So let's see this. There's a number of ways for express the employee cost payroll. We may have a salary, we may have wages, we may have commission, we may have a piecework, we may have bonus, you can have a benefit. So salary can be annual, monthly, weekly. Wages, that means you're paid hourly. Commission, that means you're getting percentage of sales. Piecework, that means you're paid by the piece of the production. Bonus, it can be start bonus, it can be Christmas bonus, it can be overall bonus, different bonuses. But it's above the base salary. And benefits, it's the extra compensation which is not directly paid. So the employee may get a bonus, benefits of free cell phone, or free company car, or free parking, or free membership to golf club. All those are considered benefits. Now, we're going to have a two types of time. One will be the straight time, which will be paid based on the base rate, and overtime, which is additional time. Now, in this case, I strongly recommend you, since you're going to the accounting, to familiarize yourself with the Business Employment Starter Act to understand what is the regular time, what's the overtime, when the overtime is paid, how the overtime is paid, how much is this, how much is that. But general rule is overtime, the employee getting paid 1.5 time on the base time. So let's see this, over 40 hours on the payroll over the week. Actually, it's 80 hours over the pay period, if it's pay over 2 weeks. So 1 week you can work 20 to 42 hours, next week you're working 38 hours, then you don't have overtime. You're not entitled to 1.5. So let's see this one. In this case, employee paid on the weekly basis, employee earned $20 per hour and worked 42 hours. Company pays time and a half for the overtime. What that means, they pay $30 for every hours over the 40 hours. So what will be the gross or total pay? $800 for the 40 hours and another $60 for the 2 hours for overtime. That will be $860. That's how much the company has to pay to the employee. Now the question is, how much the employee is going to get? Now, here we're going to the point of gross pay and net pay. Gross pay is the total amount of salary, wage, commission, piecework, bonus, and anything prior to income tax and any other deductions. Net pay is the amount that the employee gets in his bank account. Means that the gross minus all the deductions. Simply way to put it is, gross amount is the money that the employee employee wants, but never gonna get. Net pay is the amount that employee doesn't like, doesn't want, but that's the only thing that he's gonna get. Why? Because we have deductions. What kind of deduction? Payroll deductions. So for every employee that the employer pays salary or wages within the payroll, the employer has to deduct. Those are called statutory deductions, income tax, Canada pension plan, if the province is other than Quebec, or Quebec pension plan if the province is Quebec. Employment insurance premium, and these amounts can be determined using the online calculator. Now for the online calculator, let's see how the time is. If we have time today, I'm going to show you. If not, I'm going to show you next time. Now, they might be optional deductions. The optional deductions are if the employee contributes for the registered retirement saving plans or registered pension plan from the employer, union dues, some insurance premiums, charitable donation, and anything else. So you have a statutory deductions and optional deductions. Again, statutory deductions are, you cannot skip those one. You have to deduct those money from the money that you're paying to the employee. Income tax, Canada pension plan, employment insurance. How much is the cost, actual cost for the employer? Well, in this case, employer has to pay, we already saw, employer has to pay 860. Is that the only cost for the employer? No, it is not. From the statutory deductions, which are deduction from the employee, employer also have to contribute. What? He has to match the deduction for Canada pension plan, which is taken from the employee. He has to match that amount dollar to dollar. Plus, for the employment insurance premium, which is taken from the employer has to add 1.4 for every dollar deducted from the employee. So if we're deducting $1 from the employer has to add $1.40. Plus, the employer has to pay worker compensation plan. So what will be the cost for the employer? That will be the base salary or the gross salary plus Canada pension plan contribution plus employment insurance premium, 1.4 for every dollar the employee contributes, plus the working compensation premium that the employer has to pay. Now let's see how this is gonna work. If Hannah gross pay is $1,500. What that means? That means Hannah never gonna get $1,500. How much she's gonna get? Well, she's gonna get $1,500 minus income tax deducted to 183. That's the federal taxes. Provincial taxes, $73.66. Canada pension plan, $85.25. Employment insurance, $24.90. Or Hannah is going to get only $1,132.47. This is the consequences for HANA. Now the question is, how much HANA cost for the employee, for the employer? Well, the employer definitely have to pay 1,500. The fact that HANA doesn't get it, it doesn't change the fact that the employer has to pay $1,500. Because those one, employer has to send it to the federal. Those one, the employer has to send it to the provincial. Those one, the employer has to send it to the Canada pension plan. Those one, employer has to send it to the insurance. And this one has to be sent to the HANA's bank account. All together, $1,500 expense for the employer. Plus, the employer has to match HANA's contribution to Canada pension plan door to door. That means employer has to pay additional $85.25. Plus, employer has to pay for every dollar HANA pays for the employment insurance, employer has to pay 1.4. That means employer has to pay additional $34.86. So the total cost for the employer is HANA's gross salary plus employer Canada pension plan, employer employment insurance, or $1,620.11. And that's how it is. Now, I'll try to remember, but if I forget, next time, ask me to show you the online calculator for the payroll. It's free, it's available for everybody, and I can show you how to use it. So if you still have to do the payroll, you can just jump on that website and just do it. Now, how are we gonna record the basic transactions? So now we know what the payroll is. How are we gonna do the entries, the journal entries? So, okay, so we have to have the payroll system in order to have to be accurate and on time. Payroll system have to accomplish the goals to be accurate and to be on time. You don't want to send the employee payroll 1 day after the payment date or the next business day. If the payment date is on Friday, you to send it the next business day, which is Monday. Now, one thing you should know, now listen carefully, if you have to do the payroll, you do all the payroll. Let's imagine when you have a new employee, that employee, you're submitting payroll on time. By schedule, they have to get the money on Friday. One of the employee, it's a new employee, can make a mistake on the bank account. Once you submit the payroll, you won't know that the bank is mistake. There's a mistake. But on the payment date, when the company, if you're using the third party company to do the payroll, once they attempt to send the money is going to bounce back. And the company is going to tell you, we're returning to your bank account this amount because we cannot process this payment to this employee because of the mistaken bank account. Now, how can you pay the employee? Because you're going to find out for this on Friday, which is the payment date. You're going to find out on Friday morning. What can you do in this situation? Now, it's very simple. Write the employee a check for the same amount.
Check.
Yes. And you're done. Don't panic. Don't get scared. It happens. Write the check. Get the people to sign it. Give the employee check. Then you're done. So the component of the payroll system are payroll register, payroll checks, employee earning records. Payroll register going to have a special journal which organize the payroll data, how much is the rate, how much is the how much is the vacation for the employee, how much is the overtime, how much is the, what else? The sick days which the employee is entitled, and all those things. List the address, social insurance numbers, date of birth, and everything like that. So this payroll register, we're going to have very sensitive information, so you have to protect that information. That will serve as a check register as well, and provide information for recording payroll expenses and related withholding. Now the payroll register is going to look like this. You're going to have the employee name, hours, regular time, overtime, total, taxes, provincial taxes, one taxes, second taxes, Canada pension plan, employment insurance. United Way, that's probably charitable donation. Total deductions amount that has to be received. What's the check that it will be issued to the employee, and how much is the office salary expense? And keep going. Now the payroll check. What will be on the payroll check? Most company pay employee by check. Nah, that's not true. Most company now pay the employees with the electronic fund transfer, which is called direct deposit. If the direct deposit doesn't happen, then you can issue check to the employee to save the day. Payroll check has the attachment. Every paid check has to have attachment, which attachment says you have to tell you what's the pay on this paycheck and what is accumulated up to this paycheck, including this paycheck. So you can have the payment for this paycheck, deductions for this paycheck, how much is the total deductions, how much is the pay, and how much is the pay on the check, plus the totals, accumulation from the beginning up to this point, how much is the gross, how much is the total, federal, provincial, Canada pension plan, employment insurance, all those things. How much is the gross, and total net, total deductions, everything. So current and total. So let's see this payroll example. Details on the payroll register shows the accrual for the weekly payroll for December 31st as 13,654. This one is the gross office salary. This is the plus gross salary, the sales salaries. To take home by after deductions is that much. So this is the gross payroll. This is the net payroll. 3 entries are required. First, to record the accrued payables for net wages, salaries, and bonuses. To record the employer share for the employment insurance Canada pension plan, and to record the payment of the salaries to the employees. So first one, office salary expenses, sales salary expenses. Then we have employee income tax payables, deduction. This is the liability to the company. Canada pension plan payable, employment insurance payable, United Way payable, that's a charitable donation most likely, salaries payable. All these things are liability for the company. This is the actual expense for the company. Now, the next thing the employer has to do is to show the matching the Canada pension plan for the same amount. That was 577.77, and employment insurance 199.01 times 1.4. So we're going to have here Canada pension plan 577.77 and employment insurance 199.01 times 1.4, that one. This is the employee benefit expense. So for the employer will be office salary expense, sales salary expense, plus the employee benefit expense. Everything else is payable. And with the last entry, we have to clear all the payables. We're gonna pay the employee income tax payable, Canada pension plan payable, employment insurance payable, and we're gonna pay cash. Then we have to pay United Way payables, third party, and cash now. And we're done with this. Now, the last thing that left is the actual payment of the salary payments. That's the only thing that we haven't paid yet. So we're gonna do this direct deposit to the employee's bank account, and that will conclude. That way you're clearing all the payables related to the payroll. Now, employee earning records, we have to keep those records because at the end of the year, we have to provide to every employee information of all the earnings, gross earnings, all the deductions, and all the net, and how much is the net payment. And that's called T4 slip. Once you go to the tax course, you're gonna see that everybody has to file a tax return. Corporation, individuals, corporations, trust. And everybody have to show the sources of income. And the sources of income as employment income, investment income, other income. So for that reason, T1 is for the tax return for the individuals, T2 is tax return for corporation, T3 is tax return for the trust. T4 is employment income. T5 is other income, other investment income. Investment actually is called investment in other income, T5. And then you can find some other forms of T. But that's when you taking taxes. So employer owes to the employee information about all the earnings and withholds during the year. And for that reason, employer prepares a T4 slip, which is due. The employer has to provide this information to the employee and to Canada Revenue up to February 28th. That's the due date for the T4, February 28th. Again, employer give the T4 to the employee and sends copy of that T4 to Canada Revenue. So if you think that Canada Revenue doesn't know your income from the employer, you're wrong. Because one of the obligations to the employer is to send that information to Canada Revenue as well. All the independent contractors. Let's see how many slides left. I think that's the only last left, which is important. Now, people who are not employee, they can be considered independent contractors. Now, for the contractors, there are different deductions. And some of the deductions, we're not deducting Canada pension plan, we're not deducting employment insurance, we're not deducting income taxes. That's a responsibility to the contractors. That's why to some organizations, some entities, they prefer to work with the contractors. Now, you're gonna see this in the tax course. There's a test that has to be applied to see is this is an employee or is it a contractor? So if the pass the test, then it's a contract. If you don't pass the test, it's an employee. Means you have to, the employer has to deduct income taxes, Canada pension plan, employment insurance. Otherwise, the contract they have to pay those one at the end of the year. But that's for the taxes. There's no implication, there's no journal entries. How are we gonna record the current liability in the balance sheet? We're gonna have two portions. Current portion of the long-term debt and long-term portion of the not payable less the current portion of the long-term. So on one side, the total debt is 90,000, 10,000 current, the rest is long-term. That's how we're showing the liability. That's only for the liability. International financial reporting standards. There's a lot of interesting things, but again, and one of them is related to the contingency. But we're gonna see this in the 332, if you are lucky to have it with me. That's all for today, folks. Questions? Questions at this point?
No, Prof.
No, bro?
Bro.
Or you tell me, we don't know anything yet to ask you questions. So every time when people don't say no, prof, that means two things. Either you're scared to ask me questions, or you don't know what to ask. I hope it's not the first one. I hope it's the second one. Well, if you don't have a questions, I don't intend to keep you longer. Enjoy the rest of your weekend. Have a great Saturday, Sunday, and successful next week. And we're going to hear each other next Saturday.
You, Prof.
Thank you, guys. I'm going to send you
Thank
the
you,
link
Professor.
Thank you, Professor.
for the recording later.
Thank
Okay?
you, Professor.
Thank you,
Perfect.
Professor.
Thank you.
Thank you, Prof.
Thank you. Bye.
Can we leave?
So, Prof, I'll resend
Bye,
you the email.
Professor.
Bye.
So I'll resend you the email, Prof.
Okay, awesome. Let's
Thank you.
communicate with the email and let's set up something.
Thanks, Prof.
No problem.
Bye.
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 Bye.